Sri, who's also joining us this morning. Sri, just counting down to open. It's all about those IT earnings this morning. What did you make of TCS and the numbers it reported?
TCS numbers obviously disappointed, and what everybody will be watching out right now will be for Infosys numbers and the guidance that is going to come be given by them. So I think let's keep our fingers crossed.
All right, fair enough. Sri, also given the fall that we saw yesterday, are you turning a little kind of cautious on the markets? Do you feel that, the overall trajectory is still very much intact? I mean, how are you viewing some of these developments?
See, on the way the markets have performed due to global impact, I think I have a view which is probably completely different from what I have a view on the domestic effect. Look at the.
We'll go back across to Sri. All right, I think Sri is back with us as well. Sri, we lost you there. You were talking to us about how you're viewing markets at the moment.
See, the whole point is, if you look at the global factors influence, and the flow starts coming into the market, be it in terms of ETF flows or be it in terms of whichever way the FII flows. I think what is more important right now is are we going to see a Fed rate hike? If we are going to see a Fed rate hike, how much will be the outflow from the emerging markets, which will actually start pushing down the market? That's one way of thinking. The other way, the Chinese numbers came out, which was not very encouraging. What does it tell for somebody like us? And my own thought process: commodity prices will continue to remain subdued. If commodity price, and that's assuming that the current production level continue to that extent. So which means that probably it's good news again from the fiscal front. You may not see your current account deficit increasing, your fiscal deficit increasing quite dramatically, or which will continue to remain subdued the way we have been seeing for the last 18 months or so. So I think there are some positives, there are some negatives. So my own thought process, then everybody will start to look at what is the domestic economy going to do in terms of the harvesting, the benefit of it, the second half in terms of agricultural or rather rural income, how it is going to start influencing the consumption stocks. And I think the market will start to look at it in a completely different manner. So all in all, I think from my perspective, the consumption story has not yet played out in terms of, rather there are still issues. Today we saw some news reports quoting the sales numbers of Unilever in terms of sales and the effect of it in the Asian, African nations, etc., etc. So our thought process is, yeah, we expect to see a stronger second half in terms of consumption growth, and that's going to probably lead the entire story in the consumption pattern, consumption stocks. Plus banking, we are very bullish on SBI. SBI continues to have best pick because I think a lot of problems are already behind the banking system, and you should start to see a growth happening, not in Q2, starting from Q3 onwards, you should see a sharper growth, because one should not forget that Q1 and Q2 of FY16 were better quarters for the banks, and actually the AQR and the bigger write-offs provisioning started happening in the banking system per se in Q3 and Q4 of FY16. So the base effect will also catch in from Q3. But we think the banking is going to be a different story altogether. You will continue to see a good growth momentum, especially from the retail side, because you're not seeing a large investment-led demand. Your project loans are not going to happen. So the credit uptake from the project loans is going to be on the lower side.
Right. I just wanted to bring up a couple more stocks for you. McDowell Holdings, if you can just bring that up. Also, Sonata Software, not the cleanest charts, but Sonata maybe just breaking out. UB Holdings, That remains pretty strong also. We'll just bring up just today's charts are fine. Sunil, High Tech and TPS Plastic. TPS Plastic is not your smoothest chart, but when it starts to move, it moves, and so that's what you got. One of the things okay, let's bring up, if you're looking for bigger stocks, Maruti Suzuki, oil and gas, everything. And so that's what the real strength. It seems like we are seeing a reallocation away from technology into oil and gas because there are very few stocks with that kind of market cap. So you have BPCL, Petronet, Indian Oil, but even ONGC, doesn't really matter which one. JK Tyre and South Indian Bank and DCB. That's I'll get into some of the charts for you in just a moment, but you can see the kind of momentum we're seeing across this world. Sri, good morning. One of the things that I've been thinking about is that markets are actually leading indicators. They're not really lagging indicators in terms of the fact that maybe what the markets are figuring out is that we may be getting to an inflection point where a capacity is fully utilized and it starts a whole private capital cycle along with the consumption cycle you were mentioning. Is it possible that the market's actually right, that the boom in the consumption added with a private capital cycle, maybe 12 to 24 months, I don't know when exactly it starts, could actually lead to very strong economic growth with the markets already factoring in?
To some extent, yes. But when you think in terms of capacity utilization at a high level, I tend to disagree over there. The simple reason that if you look at the industrial production numbers which has been coming out, it's nothing encouraging. And then every time the IIP numbers comes out, you also keep noises about the IIP numbers doesn't justify the GDP growth numbers. And that's one of the complaints which you keep hearing every time the IIP numbers are announced. So my own thought process is that your capacity utilization in certain kind of sectors, and especially in the consumption side, you will start to see increasing. And if you actually look at a lot of these companies, be it in terms of the two-wheeler manufacturers, car manufacturers, a lot of them are continuously increasing capacity wherever they have got a larger market share and the growth potential. So you have some part of the segment which is actually growing, and many of these companies are going and growing also because they've got a huge cash generation to fund their growth as well. So probably will not be using a large amount of borrowed capital for that. So that's the way I'm thinking about it right now. Second, other than that, you still going to see in some of the capital goods segment, our thought process traditionally has been the moment economic growth starts to happen, you will start to see investment-led demand, and obviously factories get set up, a larger projects comes in, you will see the benefit of capital goods also coming into play. But if you look at the commentaries by various industries, whether it is a large number of industries, the capital goods segment, you do not get the kind of confidence what you have been getting in the earlier cycles in terms of a demand growth. So all the more reason, if Chinese growth is going to slow down and the global growth is going to slow down, the availability of a lot of these the capital goods equipment and products, which is at more competitive prices, is also going to be on the high. So to my mind, you probably will see a subdued capital goods sector performance over a period of time. In fact, that segment has underperformed. But aberrations to this, whether you want to call Voltas, etc., as capital goods or not, this is all led to the window ACs and split AC sales, not only from the MEPs that they do, etc., and in different segments. So I think overall, you're going to have a blend of benefits coming from consumption leading to a consumption growth in capex in the consumption-led cycle. You'll definitely see it in two-wheelers, four-wheelers, cars. You'll see consumer durables. A lot of these capacities and a lot of these consumer durables today gets manufactured and get imported into this country from China as well. So you will see the demand continuing to be there.
From the broader markets, Sri, let's get your take as well into, as to, some of the names that are looking at, like good stories to you at this point.
Now, we continue to stick to our topics and what stocks we like is, in the larger caps we have the HDFCs in the banking space, and obviously we have Infosys, State Bank of India, and I mentioned State Bank of India is our best pick in the banking space. Then you have from a perspective of consumption story, we like in the FMCG space Lever, coming off from a lower growth estimates. You have Kotak Mahindra, Larsen & Toubro, IOC, Aurobindo Pharma, Britannia, ACC, Glenmark and Bharat Forge in the large cap. And in the mid caps, what we like is Hexaware, Sadbhav, SpiceJet, Heidelberg, BRL Logistica, NAT Technologies and Navneet Education. This is a form of this forms of our topics, and we are sticking to our topics.
Sri, do you feel perhaps lately there has been a slight tilt towards the defensives once again, given that investors have been scouting A for valuations and B a little cautious given the global environment as well?
I think I do not want to go back and say that it is a shift towards defensive, but I would rather look at it and say that the kind of growth expectations, the kind of companies that you have seen in the FMCG space, if you call it as defensive, is going to be extremely expensive, and it has remained expensive for a good amount of time. It's never been cheap, because all these companies have got free cash generating companies, and in that environment you are actually seeing higher valuation. The second part is when a lot of run-up has happened, and when you are not seeing the a justification for the kind of growth expectations that you have put in, you have estimated in terms of, be it in terms of cyclicals, be it in terms of some of the capital goods. I think the money is bound to move into some of these segments where, especially in the consumption area, where FMCG, two-wheelers, etc. are included, which are part of that consumption story, which is a theme which is running. Third part, again, when we say defensive, pharma used to be a part of the defensive. But if you look at the entire pharma story per se, the big four, with Cipla, Reddy's, Sun and Lupin, etc. So all these companies have got significant amount of their revenue coming from US generics. And now that's not a defensive. In the generic space, you're seeing a profit degrowth, and you're seeing the valuations coming off. So to me, today defensive has been restricted to a great extent to the FMCG space, and it's bound to be there. And that's the reason why we still have Lever and Britannia. Probably Lever have continued to spend and invest during a downturn, and they should be the biggest guys to have the benefit when the upturn starts to happen. And that's why we like that space, and the preferred picks among within that space continues to be these two.
Sri, what about commodities? Let's talk about that, because we've seen a run up of late, and now we've seen that cool off. So continues to be volatile somewhat. But would you say perhaps this is now a good time to start looking at select names within that pack? Too early? I mean, perhaps now is not the time to write them off anymore.
See, when you say commodities, which are the items that you are trying to look at? Is it metals, ferrous and non-ferrous? Then you have oil, then you have paper itself as a commodity, etc. On the domestic side, when some capacity is shut, you're obviously going to find a demand-supply mismatch in the shorter term, and that pushes up the price, and naturally you see every stock in that particular space move up. And paper, it has happened already. So can we look at it as a structural story for the next couple of years? Answer is no, and that's what I think at this stage. So obviously the focus is not there. Then even in the metal space, you have seen anti-dumping duties, or there are restrictions put on imports, especially on steel. So obviously there has been a little delta which is coming up for steel companies on the various aspects. So you have seen some of these steel prices move up. But when you see something like Chinese data coming, the economic data not being so good, you have so much of capacities out there. The kind of pressure that is going to be in the global market from a supply is continuing to remain high. So does it make sure that does it ensure that probably the profitability of the commodity companies, especially steel companies in India, will move up? Answer is again no, because there is going to be a lot of pressure. So it will remain as trading stocks. As a demand, you'll see the ups and downs, in a volatile manner, depending upon the kind of effects of duty structure and the benefits, etc. Now you look into something else like cement. Cement again has had a bad quarter in terms of volume because of extremely heavy rains. But you look back, you expect to see a 4% growth in cement over the last few years, and if the demand is going to around 8 to 9% over the next 12 to 18 months, then you obviously have a delta in cement, and your cement stocks have already run up in anticipation of it. So I think it's each sector and commodity itself is going to be playing a different role. And you were mentioning about sugar. Sugar is classic case where you've seen a shortage actually resulting into a huge gain, probably after 5 years of being in the lull. So I think these kind of commodity cycles is probably best when it is down, not when it is actually on the up.